Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Ash Patel. Ash has been a full-time commercial real estate investor for almost 15 years. This was after 15 years of a corporate career. He is a value-add investor and has purchased and or developed retail, warehouse, flex, office, industrial, land, mixed-use, medical, restaurants, etc. It looks like a little bit of everything under the sun. And then from vacant buildings to fully leased triple net properties. The consistent theme is extraordinary returns. He is a hands-on property manager and also teaches others how to invest in non-residential commercial property through his CRE mastery course at Invest Beyond Multifamily. Ash is a champion of CRE and commercial real estate and helps others. He has spoken on a number of stages and to this day still takes time to educate others. So Ash, can't wait to have this conversation. Welcome to the show.
Thank you, Keith. Excited to be here, man.
Yeah, for sure. I always like to start with kind of where you grew up and what eventually led you to real estate. So tell us the story.
Yeah, grew up in New Jersey, born and raised to some strict immigrant parents. They kind of set my path. I was going to be an IT person because that's what my older brother did, right? So I went to college in Indiana, got a job afterwards, moved to Cincinnati, had a 15-year IT career. Throughout those 15 years, always had a side hustle because I didn't want to work for somebody for the rest of my life. Had several businesses that I started, some worked, some didn't. And it wasn't until, years into my corporate life that I found commercial real estate, and it changed the trajectory of my life.
That's awesome. And I guess maybe tell us a little bit about, so some of those side hustles, were some of them in real estate itself?
No.
Okay.
Look, the first one was during the tech bubble, right? So everything internet related was hot. This was late 90s. And I was an IT guy by trade. So I said, okay, I need to find a side hustle. What can I do? I'm an IT guy. I should be able to maybe make websites. Bought a bunch of books on how to make websites, started making them at home. They looked like they were homemade by some kid in the basement. I'm not a designer. I'm not very creative when it comes to that. So I looked for people that did web design full time and that would maybe want to do it on the side. So I got them and I said, okay, listen, if we have clients that I can sell to, we have website work. Would you be willing to do some work after hours? Sure. So put together a team of people and my job was to sell websites to clients. And what happened was we sold a number of websites. And back then people thought once you have a website, you're an overnight millionaire. Literally every day on the news, there was a new overnight millionaire. And this was the era of like Napster and Webvan and, all those internet businesses were blowing up. So our clients had these websites and nothing changed. So they're like, wait a minute, we have a website. Why did my business go through the roof? Well, you got to market it. So our company evolved into a full-fledged marketing company. And after doing that for about 18 months, I thought, you know what, man, I made it. This is making good money. I'm going to quit my job. I was probably 23 years old, and I did the dumbest thing ever. Went out, partied all night, celebrated me quitting my job the next day, walk into my boss's office at noon, 4 hours late for work, shorts, Hawaiian t-shirt, big water bottle because I was so dehydrated. And I walk in there, give him my 2-week notice. He's like, can I talk you out of it? No, my mind is made up. He's like, well, let's sit down and talk. Had this long conversation and I sold out. I walked out of there with a raise, a promotion, and an assistant. And I thought to myself, why am I killing myself? Because I'm working 40, 50 hours in my 9 to 5 W-2 job. And every minute of every day beyond that was spent on this business. And the money didn't motivate me at all. We had plenty of money coming in, but it didn't change anything. And I thought the whole reason to do the side hustle is to get all this money and buy these crazy cars and this and that. Well, I didn't do anything with the money. It did nothing for me. So I'm like, you know what? I'm going to buy my time back by just focusing on my W-2. They made life easier at work and I'm done. I gave the entire business to my partner at the time, still runs it today, 20 years later, and got back in the W-2. Maybe a year later, started another side hustle, another one. One of the ones that was really taking off was we started a sports supplement company, and I had the brilliant idea of calling it AmazonSupplements.com. And back then, Amazon wasn't who they are today. They weren't selling everything you can imagine. So I looked, they were not selling supplements at all. So we called it Amazon Supplements. 1 year into the business, we started making a lot of money, a tremendous amount of marketing effort to get this business launched. And we get a cease and desist from Amazon's attorneys. And they want us to shut down and hand over all of our intellectual property to them. And I thought, Amazon is the name of a jungle. How do you trademark everything Amazon? So I did some case law research and I found there was a guy in South Africa who started a company called Amazon Books before Amazon started what they're doing. And he had millions of dollars in attorney fees, sued them, and lost. So I'm thinking, I don't have any money. How am I going to fight Amazon? So I asked for 6 months to give us time to shut the company down. There was nothing to shut down. I just wanted 6 months to continue to milk profits. We did that, and I thought their lawyers might forget about it. They didn't. Sent us a follow-up letter. We had to turn everything over to them. And, it went on and on, different businesses. And it wasn't until that first mixed-use building that I bought where I had commercial tenants and I had residential tenants. And I saw these college kids were putting holes in my walls and I'm having to unclog sinks and toilets. And the commercial tenant was putting their time and their money into my building, making improvements. And I'm thinking, why would anybody invest in residential when you have commercial tenants that will self-manage and make improvements to your property? Dropped what I was doing and became a full-time commercial real estate investor.
Nice. Okay. Fantastic. And what was one of the first properties from a commercial real estate that you got involved with?
Yeah. So it was that mixed-use building. And if I'm not mistaken, the next property that I bought was an empty 15,000 square foot retail building. And I spent 6 months just marketing the hell out of that property, got it leased up. Then I bought a half-built office building. There was a developer who started building it in 2008, ran out of money. The market collapsed, so he couldn't get any more loans. So the building was a shell. Bought that, spent months finishing the construction, getting tenants in there. And beyond that, I bought strip malls, medical centers. We've developed industrial. I've bought a little bit of everything non-residential. I am not good at managing residential tenants. If they give me a sob story, I fall for it every time and I get screwed. I've gotten my butt handed to me all the time with residential. And, I went back. I thought I found a good deal on some houses and duplexes and whatnot, bought them, and I just got killed on every one of those deals.
Okay. Yeah, it's a different animal for sure, commercial versus residential. when you bought these various ones, I mean, turning around a vacant strip center, doing some things like this, were those endeavors that you were doing just with your own capital? Were you raising capital for them? What did the funding look like on those?
Yeah, Keith, for the first probably 10 years of my investing career, it was all my own capital. My first building was $230,000. We didn't come from money. So it was just, 230, next building, maybe closer to 300, then 400, and just went up from there. However, excuse me. However, I was so afraid to take other people's money, to take investors, that I lied to myself and everyone around me. And I said, there's a sweet spot in commercial real estate between 300 and 600,000. That's where the returns were the highest. And really, that was a lie that in my mind appeased me and reinforced what I was doing, staying in my comfort zone, not raising capital. I've got a very good friend of mine who's a huge multifamily syndicator. And on every one of these deals, he would say, did you raise money for it? No, I'm good. I got it. He's like, well, you should have raised for it. And he got so tired of telling me this. He finally, every deal that I did, he would just mumble, yeah, should have raised for it. And what it turned out was I was just too afraid to take other people's hard earned money. What if I lost it? What if the deal didn't go the way I planned? And it wasn't until many, many years later, I saw a lot of my high net worth friends investing in bars, restaurants, crypto, marijuana companies, and all kinds of crazy things that they were not getting a return on. So throughout the years, they would ask me and say, Ash, we'd love to get in on one of these real estate investments with you. Yeah, you know what? I'll let you know. Thank you. But I don't need your money right now. If I do, I'll let you know. That was just me being scared and hiding, right? And when I finally saw that if I let these people into my deals, they would, for the first time ever, make a return on their investments, I did that. And it was amazing because now these high net worth individuals who had focused their entire life on whatever their craft or their business was, they have no financial education whatsoever. They were finally getting a return on their money. And now they've become investors for life.
That's a good point. And I get both sides of that, right? I can understand the being, and there should be a level of being concerned about losing people's money. Obviously, you want to, be sure that you've had a proof of concept, that you know how to execute on your business plan and all of that. And I think sometimes we take too long to make that bridge and that step when, really, many of the folks that are in our sphere of influence could benefit from taking that leap a little bit sooner. Go ahead. I'm sorry, you were going to say
on
something.
the flip side, I would rather err on the side of waiting too long versus what we've seen a lot since 2020 is we had young people get into the syndication business and they go to a boot camp, a mastermind. They read some books on multifamily syndication or watch some YouTube videos and they start raising capital from people without the experience, right? They haven't earned the right to take somebody else's hard earned money by simply going to a mastermind and following a playbook. And you see this today with multifamily. There's a lot of syndicators that pause distributions and now they're doing cash calls and they're getting slaughtered, right? So you have to earn the right to take somebody else's money.
Yeah, for sure, for sure. And when it's your own money, you're the one having to figure it out and go to the next step and say, okay, gosh, I've got to. What can I do to keep this deal alive? Kind of thing. When it gets bad, and it's a little. Going through those exercises on your own deal is a lot better than having to do it when other people's money is at risk. On some of the deals that you have done, what were maybe some of the differences between the various asset classes that you found either you liked or disliked between the ones that you purchased?
Office is probably the hardest. Retail is relatively easy. Medical, simple. Large industrial, flex space, easy. The challenge with office is they're kind of like apartments. They're often, smaller offices are 1 year leases. You might get a 3 or a 5. But if the tenant leaves early, you're not going to go after them, right? If somebody's paying $2,000 a month, $1,500 a month, and they sell their business and they no longer need their office space, are you going to say, well, you signed a 5-year lease, you owe me this money? No. Or if somebody's business fails, mom and pop, small business fails, you're not going to kick them while they're down and go after them. So the challenge there is the turnover, similar to residential with small offices. When you have larger offices, you can get those 5-year guaranteed leases, personal guarantees, corporate guarantees. But there's just, one office building can have 10, 20, 30 different tenants. And there's always going to be some level of turnover. And you also have to deal with cleaning common areas, hallways, bathrooms, exterior. With retail, there's no toilets to clean. Whoever signed a lease is responsible typically for all of their maintenance, all of their repairs, HVAC, or they pay a triple net fee where if the roof needs to be replaced, the parking lot needs to be resealed, they contribute towards that. So it's just retail's way easier to manage. Medical is probably the easiest because those are typically triple net leases and the tenants handle everything themselves. Plus, medical tenants are sticky. Once they're there, they typically don't leave. Imagine if you have a podiatrist or a dentist or an optometrist that has been in one location for many years. They really can't leave because it's a turnkey facility. If they leave, you can call up a competing podiatrist and say, hey, I've got this office that's been a podiatry location for 20 years. It's empty, ready to go. Come on in. They have a built-in patient base because so many of the residents are used to going there when they have a foot problem or the eye doctor was there, right? So medical tenants often don't want to abandon their location because their customers are used to going to that location.
Yeah, that makes a lot of sense. I also think about, some of the equipment and various things. I mean, while a lot of it can be, moved fairly easy, some of it can't, and some of it's almost a fixture within the office space. So
you're right, Keith. They have lead-lined walls for their X-ray machines. And, over the years, they'll modify their office to work for them. And if they're going to outgrow it, they'll open a second location. They're not going to typically just abandon their original location.
Yeah. Do you find those are typically single tenant, or are some of the ones that you're working with multi-tenant? What does that kind of look like?
Historically, for medical, we've done single tenant. I've had students that have had multi-tenant medical practices where maybe it was an old office building and now they have medical tenants, meaning there might be a medical massage therapist, a chiropractor, some mental health people, and just create kind of a professional medical center.
Yeah. Okay. Yeah, very interesting. And that one has always seemed like a good avenue. I have not done any of those. In office, obviously, is struggling in a lot of different areas now. I mean, do you think there's any opportunity with the office coming up? I mean, it seems like there's going to be a little bit more maybe pain before it gets better type of thing. And I don't know if we'll ever quite have the demand that we had, pre-COVID come back. I mean, maybe at some point, but.
My thought on this is it's a pendulum that has swung one way. I think it'll swing the other way. And there's several factors to this. When COVID lockdowns first happened, people started working from home. There were studies that showed they're more productive. They work more hours from home. And I think the reason for that was if you're normally leaving your house at 8 a.m. and you have a 30-minute commute, you get to work at 8:30, meet and greet some people, put your coat down, put your lunch in the fridge, you're wasting a little bit of time there. Mm-hmm. Those people still started their workday at 8 a.m., but instead of getting in their car, they went to their home office or their kitchen table and opened up their laptop and started working. So productivity increased when those work from home people first started working from home. Now that's all out the window. The latest studies are they are 3 to 4 hours less productive per week working from home than in the office. And I remember all those years, Keith, that I was in my W-2, we go out to lunch just about every day to get away from the office. And you would never see somebody having cocktails or beers during lunch. Today, on any nice day, go to any cafe that has outdoor seating during the week, you will see people sit at the same table, couple martinis, cocktails, beers for hours. And these are the people that are working from home. So
Right.
everyone's gotten used to the system. They know that they can run their errands, do their laundry, drop their kids off at different places. And I don't understand how any employer can think when you have an employee that's home, their kids are home for the summer, they've got pets. Are you telling me that you're getting 8 hours of productivity out of them? Come on, we've gotten too used to playing the system, working from home. And the way the job market is, you can't really pick and choose your employees. You're trying to hire as best you can. And there's a supply demand offset right now where the jobs are plentiful and the employees are not. Now, back to your question about is what's going to happen with office. Metropolitan downtown, city center, downtown office buildings, those high rises, I think are decimated, right? And what's happened was because those office buildings incurred a high level of vacancy, the restaurants and bars and nightlife around those buildings have suffered, and a lot of them are closing in every major city in the US. And then all those condos, those high end condos that they were building in metropolitan downtowns are now being sold for often less than what they were purchased pre COVID. All the growth has moved out to the suburbs. The millennials, just like every prior generation, I'm a Gen Xer. We all lived downtown as soon as we got out of college and started working. That's where the action was. That's where we wanted to live. The millennials at the time of COVID were living downtown as well in those higher end condos. When they were experiencing the lockdown, they got tired of living in a little box with maybe a significant other, a pet, and they wanted to get the hell out. They wanted to move to the suburbs. And that's what happened. Suburban sprawl. The suburbs have exploded. New bar restaurant openings are happening in suburbs, no longer in city downtowns. So the suburbs have exploded. Office buildings, we have a once in a lifetime opportunity to buy office for pennies on the dollar, but not in metropolitan downtowns, but in suburban areas. Those suburban downtowns that are walkable, smaller office buildings, maybe 1, 2, 3 stories, are absolutely on fire. Any investor that owns office in a walkable suburb will tell you there's a waiting list of tenants wanting to get in. So that's the easy answer, right? Suburban downtowns and really cool hipster type walkable suburbs. But you also have those suburban office parks. Now, if you think about those, the going rate, let's say, was $20 per square foot pre-COVID for Class A suburban office space. Well, those investors that purchase those buildings at top dollar, they need that $20 a square foot so that they can make their mortgage payments. Now they're going to auction. And if you can buy those buildings for 40 or 50 cents on the dollar, you can afford to lease them out at $10, $11 a square foot, while your competitors are still leasing at 20, or maybe they've dropped a little bit. But because your cost basis is down significantly by buying these buildings for pennies on the dollar, you're able to readjust rents to 50% of what it used to be. And there's still demand for office, nowhere near what it was, but there's still plenty of companies where employees go in. Maybe it's a hybrid solution. Maybe they get Fridays off or half their workforce works from home, but there's still plenty of people in offices. Granted, 40%, 50% vacancy.
Yeah, yeah. No, I tend to agree with you, and I've seen it as kind of an opportunity at some point. But I do think it. Obviously, you got to find the right deal, and financing and all that can be a little bit tricky right now. And what are you seeing as far as financing right now? As far as how much somebody will lend on various asset classes.
Office is still considered toxic unless you're in that walkable suburban downtown. We've had lenders that will say, we're not lending on office, but when I present a property that's in a great demographic, great location, regardless of if it's fully vacant, they love them. They will finance those because they know the area is right. They know your track record. They know you can make money on it. In commercial real estate, and especially value add commercial real estate, lending relationships are everything. In the residential multifamily world, people treat lenders as commodities because there's a secondary market to trade those loans. Just like your single family house, whoever's servicing that loan or whoever you got the mortgage through, every couple years, it's a different bank that now takes over your loan. So there's a secondary market for most residential properties. For commercial value add properties, whichever lender does your loan, it typically stays on their books forever for the life of the loan. So lending relationships are incredibly important in our world, which is why we choose loyalty over, maybe getting a better rate. For years, I paid a little bit higher on my loans just because I found a lender that believed in me, financed all these crazy deals. So I was okay paying more. And having that track record, having that relationship today is everything because lenders are very skeptical today.
Yeah. And tell me a little bit maybe about your current portfolio. Where all are you invested? Is there a specific geographic area that you're interested in? Then I'd love to hear about what your current buy box is.
That's funny. The buy box question is what's funny because we don't really have a buy box, right? I've got two great business partners now, and both of them say, okay, we got to stop doing deals under $1 million. And, I'll find something that's $300,000. It's such a huge win. I can't not do it, right? And maybe it's a bit silly. I try to keep in mind how much of my time it's going to take up, but I've got a good staff now where I can offload property management on some of those smaller properties. So buy box is anything that has high returns. I don't care what the asset class is, as long as there's no residential, as long as it's all commercial. So buy box is all over the board. Where we've invested is historically throughout the Midwest and the Southeast. I've also partnered on a lot of deals. I've invested in a lot of other people's deals as well. So today, if we had to pick, it's focused on medical, industrial, and retail.
Okay. Makes sense.
Well, and what does my portfolio look like? I have no idea because I've got a number of syndications, partnerships, passive deals, but I would say probably 70% of what we own is retail. So 70%, maybe 60, 70% of what we have is retail, 20% industrial, 20% office, and just some other crazy stuff mixed in there as well. Some restaurants, bars.
Okay. And on the retail, I guess maybe tell me a little bit about that. Is that set up as triple net? And then also, what size retail are you typically investing in? What are some of maybe the types of tenants that you're looking for there?
We'll do the gamut. I've bought strip malls in rural towns that have no population growth, but it's a great cash flow property, right? And knowing that when you're buying in those small tertiary towns where nothing's changed in the last 20 or 30 years, you have to know that there's going to be little to no appreciation on the property. So those properties have to cash flow significantly higher. I rarely buy fully leased triple net properties unless they're mismarketed and mispriced. Most of what we want to buy is value add retail where there might be a national tenant or two, some mom and pops, and some vacancies, right? We don't want to park money. We want to significantly grow money. We've bought strip malls that were under construction. We buy them off the developer before they come to market. We love triple net, but we want to be the ones to get to the triple net. Meaning, we might take over a strip mall where it's a mixture of gross leases, triple nets, and over time we convert the tenants to triple net. And the benefit of doing that is you're now attracting a higher quality of buyers, a wider audience of buyers. Coastal buyers will buy triple net properties in the Midwest. They don't want to buy, gross leases where they have to manage repairs and maintenance, and they want easy cash flowing mailbox money type properties.
Yeah. Okay. And so, with a lot of what you've got currently, how long are you holding these? if you can talk maybe a little bit about, with some of your investment partners, kind of what type of returns should you be able to anticipate? Anything like that you can kind of give to us would be great.
Tell me if you agree with this, but most people get into real estate and they think buy and hold is the way to go,
Hmm.
right?
Yeah, yeah.
And I teach this where everybody starts out in real estate and it's the goal is buy and hold, accumulate this huge portfolio, pay off your mortgages, and all of a sudden you've got some great passive income. And I thought that was the right thing to do for many years. I had another friend of mine who's actually a multifamily guy. I bought this $5 million strip mall. And one night I'm at his house and he says, "Hey, what are you going to do with that?" I said, "Oh no, this one, I'm keeping this one forever. It cash flows ridiculous. Like this is a trophy property. I'm keeping it." And he said, "No, get it to 80% of where you want it and sell it." I'm like, "No, you're crazy, man. Like you have no idea what you're talking about. This property is a unicorn. I'm keeping this one forever." And he just kept pushing and made me realize that the way to build wealth is exactly that. Get the properties 80% improved, leave 20% upside for the next buyer. So there's some meat on the bone and sell them. Continue to turn and burn, right? So that's essentially what we do. We don't have any properties that we have to sell, and the market isn't great for selling. But if we're in a high growth area, there's a lot of demand and we've improved the property significantly, we'll sell them. But that's what we want to do. We want to mostly improve the properties, build a ton of equity, and sell them. In terms of returns, this may come as a shock, but we turn down 10, 11, 12, 13% cash on cash deals all the time if there's no upside. And I'll give you an example. This one property we intercepted from a developer. My business partner calls me. She lives in Atlanta and says, "Ash, this developer is building a strip mall. I want to buy it." And I said, "There's no money in new construction because it's going to be priced at market rents. Everybody wants a shiny new strip mall." She's like, "No, like we need to buy this." So I fly to Atlanta. We set up a lunch with the developer and we tell him we're very interested in buying this. We want to buy his other developments, put on this dog and pony show. Month later, he comes back with numbers. And some of these properties were pre-leased. Actually, 90% of that strip mall was pre-leased before construction finished. So he comes back and he gives us a number and it's at market rates. So I told my business partner, I said, "Look, good A for effort, but exactly what I said, what was going to happen is what happened. He knows how to price this. It's priced at market rates." It was 13% cash on cash returns, but there were 5-year leases. Everyone had, I think, a 3% annual rent bump. So over the 5 years, there's marginal increases, but there's no big upside. And I said, "Let's just move on to the next deal." She's like, "No, like there's got to be a way we can buy this." And I said, "We've exhausted everything. Time to move on." She's like, "Give me one more day and I want to see if there's an angle here." She reads through the leases and realizes the developer didn't put any renewals in the leases, which is insane because in 5 years, these tenants have restaurants and boutique stores and gyms that the developer and them, they put a lot of money into their space. And in 5 years, there's no renewal. So what that means is we can go in there and say, "Hey, look, you're paying way below market. We're going to get you closer to market rates with this 5-year renewal." And they don't really have a choice, right? Because if they leave, we can get another tenant in for the same or higher amount of money because it's a turnkey restaurant, a gym, a salon, whatever it is. So that was a huge home run because we're in the 4th year now. Rents are way below what they should be in terms of the market. And we were able to find a great way to purchase that property by reading the leases and realizing that there's no renewals in them. So that was a deal that we would have walked away from, 13% cash on cash returns. But in one more year, when that 5-year no lease renewal mark hits, we get to renegotiate with all the tenants and we have all the leverage.
Yeah, it's interesting how the little things like that, if you can just look at what angle you can take it, that turns a okay deal into something that really could be a home run for you.
Creativity wins in commercial real estate.
Yeah, for sure.
right? And we don't have a lot of competition in this arena relative to anything residential or multifamily because every deal is so different. There's no cookie cutter approach you can take. We have a strip mall where there's a giant parking lot, and when we underwrote it, we thought, it'd be nice to put a Chipotle or Starbucks in the parking lot because no one's using this parking lot. Strip malls that were built in the 80s, they overdid the number of parking spaces, right? You
Right.
just don't need them anymore. Well, we found a national coffee company that wanted to buy 30 parking spots and build a drive-through coffee shop, and we were all ready to go. We found that our anchor tenant there, which was a Dollar Tree, they had a sightline provision in their lease. And what that means is you take the two front corners of their storefront, draw two straight imaginary lines to the main road. Nothing can impede that view.
Hmm.
So, that um, initially we had a larger national tenant that we were going to put there, but because of that sightline provision, we had to put a coffee company that's just one of those skinny drive-through type deals where
Yeah.
they didn't block the sightline, right? But every lease that we read learns something new, right? Every deal that we do learns something new. So it's never ending. That one strip mall has maybe a dozen tenants. Every one of their leases is different. So underwriting commercial is much more unique, less cookie cutter, less uniform. And that's where the creativity will win.
Yeah. What are maybe some other aspects that might be in a lease that you need to be aware of? You mentioned the sight line, which I'd never heard that one before, so that's pretty interesting. You mentioned the non-renewal at the end of the one potential or the one that you purchased that soon they'll have to renegotiate. What are maybe some of the other things that might be little hidden gems in there?
One of them are most often you'll see anti-competition clauses. So if there is a pizza place, you cannot have anyone else that sells pizza. If you have a Starbucks, no one else can sell coffee. Even a grocery store that maybe sells packaged coffee, you have to get an exception, right? There might be some clauses where if the anchor tenant goes dark, if they leave, we get to pay half the rent that we normally pay because we wanted a lot of traffic as overflow from Aldi or JCPenney or whoever it was. And if they're not there, we shouldn't pay the same amount of rent. So in those situations, you've got to make sure your anchor tenant is healthy, has plenty of years left on their lease, or if it's coming up, that there's a good chance they're going to renew. What else do we have for strip malls that you see in leases? There's so much. Some of them, there might be a sales kicker. If their sales are over $10 million a year, you get 1.5% of that number.
Hmm.
If their sales fall below $10 million a year, they get a discount on rent, right? So
Interesting.
there's
Yeah.
there's all kinds of different clauses in leases where you literally, some of these leases are 60, 70 pages. You have to read every single word. You have to, because it's one paragraph or one sentence that can have huge implications on the value of this center.
Yeah, for sure. Yeah, it's amazing how much that can make a difference, and wow, that is pretty eye opening. So, what does your team do with respect to that? Do you have attorneys that read through the leases? What does that look like?
I absolutely hate doing it. I've done it for so long. So I thought, okay, we're going to get our attorney to write a lease abstract where they read these long leases and give us the bullet points and the summary. And we tried that. The problem was they would miss a couple things. And again, this goes back to if you miss one critical thing, you're done. It could be $1 million difference in valuation. So we could not outsource that. Luckily, I hired an analyst who's also my nephew, and he's like, "Man, I love reading leases." I'm sorry, what? He's like, "Yeah, this is so much fun." I'm like, "Perfect. You're the lease guy. You read every line in these leases," and he loves it. So it gets old, it gets cantankerous. it's just, after you do it so many times, it's like reading the same book over and over again. But it's so critical that you cannot afford to miss anything.
Yeah. What about maybe shifting from retail? Tell me a little bit about industrial and kind of what you like about industrial right now.
Yeah, sorry, I'm going to circle back on the lease question. One more thing that's absolutely critical that we're seeing more and more in leases is out clauses. Starbucks famously used to sign 10-year leases. Now they sign 10-year leases, but in year 5, they're able to exit, right? So it's really a 5-year lease, and that's how it's got to be underwritten. So having kickers where tenants can leave is very important that you identify those out clauses, right? You just have to be very cognizant of those because in retail, often the value is associated with the length of the lease. If you have a national tenant, let's take, for example, Dollar General. If Dollar General signs a fresh 10-year lease, building could be worth $1.4 million. If they're in their last year of that lease, the building's $500,000 because you don't know if they're going to renew or not.
Yeah, yeah,
Right.
that's a
So
huge
the
swing.
length of those leases and being cognizant of those out clauses is very important. Keith, your next question on industrial, social media is blowing up with flex spaces, right?
Right.
The problem is there's now a low barrier to entry to do flex. Flex is nothing more than larger self storage, right? And self
Yeah.
storage is not rocket science. There's playbooks, masterminds, boot camps on teaching you self storage. There's great systems out there, great software to automate everything. So Flex is still on fire, getting a bit saturated in certain markets, but you can still make money. I'm not a huge fan of developing new Flex space. I more prefer to buy existing or convert large industrial to Flex for a number of reasons. One of which is you can start making money a lot sooner versus maybe a 6 to 15 month development cycle.
Hmm.
So buying existing flex is the way to go. Industrial, I think, is still overlooked. Any large building, the uses are so versatile for anything from a machine shop, manufacturers, warehousing. So larger footprint industrial is still on fire and social media isn't chasing it. So it hasn't gotten oversaturated yet.
Yeah. Okay. Very interesting. And on your on your flex spaces, are those typically gross lease or those triple net, or what do those look like?
We have a combination of them, but what's interesting with flex is if you have a flex building that has some exposure to the street in front of it, you can convert that to retail flex, right? It,
Hmm.
it doesn't have
Yeah.
to be just the landscaper and the plumber. So you can put some larger windows. We've got tint shops, car audio. We've got churches in flex spaces. And, here's a great example of why commercial real estate is so great. We had a flex building that we bought. It was mostly vacant, and a church took one space that's maybe 3, 4, 5,000 square feet. Forgot what it was. It's in Atlanta. And they put in all new flooring. They built a bathroom, redid the lighting, and put drywall inside. So if that church ever leaves, and they did this all on their dime,
Hmm.
if they ever leave, we've got like a cool event space that we can rent out, right? And most commercial tenants, especially the smaller mom and pop ones, they put their own time and their own money into your spaces. The larger national tenants, they'll swing their weight around a little bit and they'll say, okay, look, I'll sign a 10-year lease. I want 50,000, I want $200,000 upfront for my build out. And it's still a win-win. But in terms of flex, we've got just a normal garage units. We've got the retail facing flex, a combination of gross leases and triple net. Our triple nets, if I'm not mistaken, are all on the ones that are retail facing, right? Like boutique stores, but they
Sure.
need a bay
Yeah.
door. Pest control companies, they need the bay door in the back to park their vans. Surveying companies, tenants that might have some retail exposure, not a lot, or like the car audio place. They have people in and out of there all day. Those we've converted to triple net.
Okay. Okay. Yeah, it makes a lot of sense. That's neat. Ash, maybe tell me a little bit more about what else people should know about commercial real estate, and really what differentiates, most of what you're investing in from, say, the multifamily, some of the residential stuff.
Keith, for 15 years, I've tried to get people to start investing in commercial, and I keep hearing the same excuses. Commercial's too hard, commercial's too expensive. No, it's neither. Or I hear there's a retail apocalypse, right? The Amazon effect. Commercial real estate is dead. So let's tackle those. Too hard. Yeah, there's a different learning curve. Like nothing's easy that's worth doing. So you got to learn how to do it. Too expensive. I can find you a commercial property that's the same price as a single family home that you live in or invest in. Or the Amazon effect, the retail apocalypse. When you see headlines, you see JCPenney closed. JCPenney survived the Great Depression and a World War, and COVID shut them down. Rite Aid, Toys R Us, Bed Bath & Beyond, all those bankruptcies make headlines. You don't see that Dollar General is opening 800 stores this year. Aldi, Target, all the store expansions are not clickbait worthy headlines. Today, in April of 2024, retail vacancy is the lowest it's ever been in history. There's never been a better time to buy retail. And it's continuing to trend with more scarcity. There's more retailers wanting to open than there is available space for them to open in. We're right around 4% vacancy for retail, right? It's the best time ever to buy retail. It's amazing how many stores are opening in 2024. But, you also see the malls are closing, the malls are dying. So people have this misconception that retail is dying. So retail is completely healthy. And sorry, the premise of your question was what?
Yeah, it was just really kind of what are some of the differences and things that people should know about commercial real estate versus investing in residential.
Yeah. So, we've debunked. It's too hard. It's too expensive. And there is a retail apocalypse. But really, you meet people that have single family homes. They've graduated to multifamily. They'll never go back to single family. I've had people that started with single families, went to multifamily, then found commercial real estate. They'll never go back to anything residential. The difference is our tenants are professional business owners. They take a lot of pride in their space. And this is where they generate their livelihood and their revenue from. Their income comes from your building. So it's a completely different caliber of tenant. They're easier to manage. We self-manage probably 90% of our properties. And the other 10%, when we bought them, there was a great property manager that we inherited and we kept them. But managing a huge portfolio of commercial property is very simple. When you manage multifamily, you get to 40 units and there's a pain point because you can't hire a full-time leasing, full-time maintenance person. And there's a lot of pain. And then once you have 100 units, you have to start building up your staff, right? It's just a level of overhead that's unnecessary in commercial real estate.
Yeah, that's a great point. That's very interesting. This has been really good. This is it's kind of neat because you have a perspective of several different types. A lot of times we have folks that focus on one, but you really have quite a few. So really appreciate your perspective. Ash, how can people find out more about you? And if they want to invest with you, where can they go?
Just go. I'm easy to find. I'm all over LinkedIn, Facebook, social media. Invest Beyond Multifamily is our company. We've got an incredible course. We've had a lot of students go through that. It's very intense. But just go to Invest Beyond Multifamily. You can find out about how to get your education to learn exactly what I'm doing.
Perfect. Okay. And if you have just another couple minutes, I've got two questions I ask every guest.
Yeah,
And
of course.
yeah, the first one is, what advice would you give somebody who's maybe just starting out in their investment journey?
Find a mentor and make sure you add value to them. It's one thing that I never had, and to this day, there's not many people that do what I do. So I have a hard time finding mentor, but I've paid a lot of money for coaches over the years. But, and I see the learning curve get shortened with people that I've mentored. Hire or find a mentor, but make sure you give them value, right? I've had so many people over the years, and they'll hit me up on social media, and if I get on the phone with them, they'll say something stupid like, "Yeah, I meant to hit you up for a long time now. Okay, what is it that I can do for you?" And they're like, "No, I want to learn what you're doing." And I asked them, "What do you think it is that I do?" "Oh, you make that mailbox money," and they have no clue, right? They have no research. I literally go out of my way to help anybody, and I have people that schedule time with me, and when I get on the phone with them, I research them. I know everything about them that's available, and I'll get on the phone with them and I'll ask, "What can I do for you?" "Oh, I just wanted to see what it is that you do and see if I can learn from you." And I said, "What do you know about me?" "Well, nothing. I just know that somebody told me to call you, or I saw you pop up on LinkedIn." And what a failure, right? Like, you're taking up somebody's time that's trying to help you. You didn't spend 5 minutes Googling them.
Yeah.
And I tell these people, look, I know this about you. You graduated from Stanford. You work for a small boutique real estate company, and you're looking to do this. And they're like, wow. Like, be respectful of people's time, and they'll give you all of it.
Yeah, no, that's great advice for sure. How about a book recommendation? Anything that you've read recently that's been impactful?
Yeah, Keith, rocket fuel for anybody that, if your desk is a mess, if you can't focus, if you're scatterbrained and have a million different things going on, you got to read this book. My whole life, I envied people that had a clean desk, and I had coworkers that were meticulous. They would do one thing at a time. And every year I'd say, this is my year. I'm going to be more like them. And it's never worked. This book teaches you that being scatterbrained and having all these crazy ideas is a gift. You're a visionary, but you have to pair yourself with an integrator, pair yourself with one of those people that have the clean desk. It was a epiphany for me, changed my life. I no longer try to be organized. I just make sure there's people around me that can help me.
Yeah, no, that's a great book. Gino Wickman. Yeah, good stuff. All right. Well, this has been fun. I really appreciate it. And thank you so much for being on the Wealth Flow. And I think we'll call it a show.
Keith, what an incredible conversation, man. I love the questions that you asked. Keep doing what you're doing.
Thank you so much. I appreciate that, Ash. You too.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.